Let's get started. My name is Venkateswaran. It's my pleasure to welcome you to this 20th Stern Economic Outlook Forum. We have a distinguished panel today to weigh in on the current economic situation, and I'm eager to get started on that. But before that, just a few words on the format and a few words introducing our panelists. The host of today's forum is the Stern Center for Global Economy and Business, which serves the university, NYU, through outreach to the broader community, including academic, business, and policy worlds, as well as our students and alumni. We're pleased to have in the audience students, faculty, and alumni from NYU all over, and I really want to express our gratitude to all of you for joining us today. Today's session, in terms of format, will begin with a brief presentation by each of the panelists. The presentations will be about 10 minutes long, where they talk about economic and current economic and market prospects, and we'll follow that up with an audience Q&A. Just in terms of the format for the Q&A, some of you have already given us questions in advance, so I will be curating those and presenting it to the panelists. For the others who want to type in a question or who want to ask questions during the webinar, please use the Q&A feature in your Zoom window. And again, as for the panelists, you don't have to look at that. I will curate those questions and present them to you as we go along. And finally, in terms of my last word on the format, our aim is to finish by 6:30 at the latest, and so roughly a 90-minute webinar. That's what we have planned today. When you type your questions in, please make sure you indicate your name. It'll be easier for me to kind of to fish that out. Wonderful. So now, without further ado, let me go ahead and get started on the introductions and start introducing the panelists. Our next panelist is Matt Luzzetti, who is the chief economist and the head of U.S. economic research at Deutsche Bank. He has also worked at the U.S. Department of the Treasury in the Office of Financial Research and spent a couple of years as a research analyst in the macro department at the Federal Reserve Bank of Philadelphia. Matt holds a PhD in economics from the University of California, Los Angeles, and we are delighted to have him join us as well. Our third panelist is Joyce Chang from JP Morgan. She will join us in a few minutes, and right before she speaks, I will use that opportunity to introduce her and give you a short bio at that point. Once again, thank you so much. Oh yes, here's finally, I think we might actually, Joyce is joining us, so just give us a minute, and then once she comes on board, there you are. So we are very happy to have Joyce Chang, who's the chair of global research at JP Morgan, join us for this panel. She's held numerous leadership positions across the industry and policy, across the financial services industry and policy spheres. She was a managing director at Merrill Lynch and Salomon Brothers prior to joining JP Morgan. She serves on the advisory board, the external advisory board for the Center of Financial Stability. She's a member of the Council for Foreign Relations and Inter-American Dialogue. She's been named as one of the most powerful women in finance, both by American Banker and by Barron's more recently. These are just a few of her accomplishments. She holds an MBA from Princeton and a BA from Columbia University, and she serves on boards in both institutions. So we are extremely happy and delighted to have Joyce join us. So the next part, what I'm going to now do is to invite each of the panelists to say a few words. I'm going to start with Matt and then followed by Joyce. Matt, whenever you're ready, take it away.
Thanks so much, Venky. Thanks so much for having me. Honored to be here with Nathan and Joyce. Over my few minutes where I provide remarks, I'm going to focus primarily on the U.S. economy. That is my focus. I'm sure Nathan and Joyce will have a more global view to present and more insights on that front. And I kind of just want to talk about what I think are the few key topics from a U.S. economic perspective today. I'll first talk about inflation in our view, being near the peak, but the big question about where do we get to over the course of this year and where do we settle down to as being the key question. On that front, just to kind of preview my thoughts, we're in an environment where we think inflation in the US remains persistently above the Fed's target. The second point, I think, is in the labor market. We just got a very strong jobs report on Friday, but it's another environment where we've had these meaningful supply-demand imbalances that have led to what looks like a very tight labor market. On that front, again, to preview my remarks, I think you will continue to have a very tight labor market over the first half of this year, but I do think that we are seeing evidence of both supply and demand coming back into better equilibrium on that front. It will take time, but it's a big story, as we get into 2023. And then the final point is on the Fed. A lot of focus there. It's been the key source of repricing in markets, thinking about rate hikes, particularly over the next year. And on that front, I think we are looking at a Fed that is much more hawkish, has undergone this hawkish pivot. We see them raising rates at least 5 times this year. And then importantly, an outlook for the balance sheet over the course of this year and next year, I think is a key source of uncertainty. And also I'll provide our views on that front, which I think will be really important for thinking about markets, the curve, risk assets, and so on. So first, starting with inflation, we've seen various inflation gauges hit several decade highs. We think over the next several months, you're going to see the peak in inflation rates. You'll see core CPI peaking out at close to 6%. Core PCE peaking at close to 5%, so nearly 3 percentage points above the Fed's target. But we do anticipate that will be the peak, and then we have inflation coming off after that. I do think that for the first time, we have compelling reasons to think that dissipation and inflation pressures will be more persistent this time. And I think it's both because you are seeing some evidence of some easing on supply chain issues, but I think more importantly, we are seeing cooling on the demand front. And so if you look at durable goods in particular, real durable goods were about 26% above pre-COVID trends at their peak. They're now down to about 4% above pre-COVID trends. And importantly, we've seen inventories begin to build, and especially for autos over the past several months. And these have been very good leading indicators for goods price disinflation over the past year to 2 years. And so I think very importantly, for thinking about the inflation outlook, what happens with goods is at the forefront. And yes, it is about supply chains coming back online, but I think very importantly, we are seeing a weakening in demand for goods, which will help to bring price pressures down. I think reasons for why inflation will be more persistent have grown recently. One, we've seen a broadening out of price pressures. Initially, if you look back to April, May, and June of last year, it was very narrowly focused on those components that were at the epicenter of the pandemic. More recently, it's broadened significantly. I think the clearest evidence of that is if you look at the trimmed mean PCE inflation gauge, it's at 3% year on year today. It's the highest in 30 years. And we've seen inflation pressures broadening out to items that are far more persistent, rent and OER in particular. The second reason that I think inflation will be more persistent is what we've seen in the wage data. Of course, we saw on Friday average hourly earnings accelerating sharply. But I think more importantly, if you look before that, the employment cost index, which controls for compositional shifts, is at the highest level since the 1980s. I think we're not at a point yet where we're thinking about a wage price spiral, but you are beginning to see wage pressures nearing those levels that are becoming more concerning from that perspective. And then finally, inflation expectations. A lot of divergences across different measures. Markets not looking all that worried. Some consumer measures looking a bit more worried. Our own common inflation expectations index that we build, which replicates some Fed work, has now risen a few basis points above pre-2014 levels and hasn't really leveled off as of yet. So inflation expectations are showing, I think, a bit more persistent move in inflation going forward. They are not yet at a level of an anchoring, but it's a concern and a risk from the Fed's perspective at this point. And so from the inflation perspective, I think we are near the peak over the next 2 months. We should see inflation dissipate over the course of this year. But the key question is to what levels? And we have 3% core PCE at the end of this year, which is, for perspective, about a percentage point above the Fed's target and about 1.2 to 1.3 percentage points above pre-COVID levels. So a very persistent price shock at this point. On the labor market front, on many metrics, the labor market looks very tight. You have very strong wage growth, as I mentioned. You have record high quits and job openings in the US. You have a record low vacancy yield rate, which is hires relative to job openings. And the unemployment rate has now, I think, given a consistent message to all of those. If you go back to June of last year, the unemployment was 5.9%. In the US, it's now 3.9%, or 4%, but it fell to 3.9%. And so over the past 6 months, it fell by 2 percentage points. And I think that was a key source of uncertainty and kind of a key surprise from the Fed's perspective, how quickly you saw the labor market tighten. A key story on this front has been, why has labor supply been so constrained? And there I would highlight 3 issues. For the 55 plus age group, there's been this pickup in kind of excess retirements above pre-COVID trends. We put that at about 1.3 million of retirements above the previous trends at the moment. And I think a key source of the reason why we haven't seen, why we've seen this big drop in 55 plus labor force participation has been wealth effects for this group. There's some great work done by the Federal Reserve Bank recently, which suggested that 0.9 percentage points of the decline in participation for this group can be due simply to wealth effects. The second source of this tight labor supply is for the prime age group, those 25 to 54. And a lot of that is about caregiving needs. When we ran an analysis several months ago, looking at the micro data, basically all of the decline in prime age parents can be due to a rise in caregiving needs. And that's the disruptions that have been created by COVID, the continued disruptions that we saw last through Omicron. And then the third source of labor supply tightness I would note is a lack of immigration flows. If you look at the working age population foreign born in the US, it's about 2 million below the pre-COVID trend at the moment. And so that is another meaningful source of decline in labor supply in the US. I think going forward, labor supply will likely remain constrained over the first half of this year. It will keep the labor market tight, looking significantly tight, wage growth remaining elevated, keeping the Fed on a tightening trend, at least in the near term. But as we go beyond the near term, I think, hopeful that we will see labor supply coming back on board more meaningfully. The latest data, I think, was supportive of that. Prime age participation has risen by more than a percentage point over the past year. The 55 plus age group has begun to bounce back a little bit. And I think also importantly, we're beginning to see early signs of labor demand peaking. If you look at the NFIB small business survey, job openings are now declining. Indeed is showing job openings declining. And I think the JOLT survey will begin to show that evidence over the next several months as well. So finally, where does all this leave us from the Fed? And obviously that's been the main mover from a market perspective, with the front end really repricing the Fed significantly. I think there we've had this remarkable hawkish pivot from the Fed. It began in June of last year, really accelerated in December and January, with the Fed doubling the pace of tapering, beginning to signal 4, if not 5 rate hikes this year. And our main view on the Fed is that they will tighten at every meeting until they receive compelling and convincing evidence that price inflation is going to abate. I don't think they're going to see that evidence over the first half of this year. And so we think that they're going to raise rates in March, May, June, begin quantitative tightening in July, and then raise rates in September and December for 5 rate hikes this year. I think importantly, I see the risk to that as being skewed to the upside, so that the Fed may have to move even more than what we have penciled in. And that would come if the Fed does not, if we don't see inflation pressures abating, as I just mentioned at the outset. I think a final key point here is on the balance sheet. It's a key source of uncertainty. The Fed hasn't guided significantly about the parameters around this, but our own estimates are that the Fed is going to reduce their balance sheet by about $1.6 trillion over the next year through the end of 2023. There's a lot of work being done, and I'm happy to talk a bit more about it, about how to equate this into rate hikes. But our own estimates suggest that it's worth 2.5 to 3 rate hikes through the end of next year. So we have 8 rate hikes from the Fed, in addition about 3 rate hikes coming through quantitative tightening. And we're talking about more than 10 rate hikes in total, effectively, in terms of Fed policy tightening that we're anticipating through the end of next year, which I think is a meaningful response, a meaningful hawkish response. I think from the market perspective, that is the key story, the hawkish risk that we have from the Fed, but also the fact that we have much less forward guidance to rely on from them. They're not going to guide about the path forward. It's going to be an environment with substantially more volatility for markets. It's difficult to know exactly where we should have the Fed priced in the near term. And also the source of quantitative tightening potentially being a source of steepening for the longer end of the curve is another key story. So just to summarize from my perspective, nearing the high in inflation, we should see it dissipate, but inflation pressures remaining persistent for longer. The labor market remaining tight, at least over the first half of this year, keeping the Fed on a tightening trend. But I do think that there's hope to see that labor supply comes back more forcefully. And then from the Fed's perspective, they will be tightening, we think, at each meeting this year, either through the balance sheet or through rate hikes. And we see upside risk from that. Certainly the question then is can growth be resilient to that? But I'll leave that hopefully to questions for later.
Wonderful. Thank you so much, Matt. That was a great opening. What I'm going to do next is invite Joyce to make her opening remarks. I'm going to go ahead and share the slide deck right now, Joyce, and then you can guide me as we go along. So if you see your slides on there, you can start and then just guide me on how I should advance them.
Thank you so much, Venky. And it's a real pleasure to be back at the NYU Economic Forum and to be with Matt, who I have just so much respect for, and so much respect for NYU and all of the work that you're doing. So let me just start by saying that I do think we are undergoing a period of regime change, and this time is different. That's the key message I want to leave. We have a transformation of the macro, the market, the political landscape, which is going to play out for years to come. And I do see COVID-19 as accelerating paradigm shifts to this regime change, really bringing in a world of higher inflation, bigger deficits, greater macro volatility, and faster moving business cycles. So there's two things that I want to stress that we see as far different from the past two expansions. First is the expansion is reflationary. We do see global inflation, excluding energy prices, settling anywhere from 50 to 100 basis points higher than pre-pandemic levels. And we do see developed central banks moving to earlier monetary policy normalization starting in March. For the Fed, we have the Bank of England moving as well. We now have the ECB also beginning to hike rates in December of the year. The second thing I would say is that what's also very different about this expansion is that the credit and the balance sheet problems that were headwinds in the past that have characterized the post-financial crisis expansion have been replaced by tailwinds. Private sector liquid asset holdings are elevated across the globe. And this means that the demand growth, I think, should remain strong. So let me turn to the first slide with our economic forecast. So what we're looking at is above trend growth, but inflation trends that are going to persist. And we're forecasting global growth at 4.2% this year, US growth at 3.7%, emerging markets at 4.7%. And notably, we do have China slowing to just below 5% growth, 4.9% growth. Latin America is the laggard with only 1.7% growth. But when you look at this chart, it's actually hard to think of a year that I can recall where you've had growth really converge, 3.7 for the US, 4.6 for Europe, 4.9 for China, 3.3% for Japan, all within 1.5 percentage points of each other. I want to stress that stagflation isn't a concern. If you look at the underpinnings for growth, we think it is strong, supported by private sector balance sheet. But the first quarter of the year, I think, could be the weakest quarter of the current recovery. I would describe this as a sandwich. We had very strong growth in the fourth quarter of the year, the US 7% up. We have Omicron, a slowdown in the first quarter coming down to 3%, and then a 5% pickup in the second quarter of the year. Similar trends also in China, where we have a slowdown this year and then picking up in the second quarter of the year. What I would say is that makes this recovery different is that the output gap will close in early 2023. That's less than 3 years into the expansion. And this compares to a full 8 years for the output gap to close after the global financial crisis. And that was a big disinflationary force. The level of developed market GDP is expected to end 2022 about 0.5 percentage point above the pre-pandemic path, with the US about 1% above. So this does mean higher inflation. So turning to the next slide. Just a few words on Omicron. We've seen this as a sharp, short, and synchronized downturn, more infectious, but less damaging. If you take a look at our Google activity index, we see that activity has remained strong during this. So it's not the same damage that we saw to the supply chains or to the manufacturing sector. It's been much more of a fall in consumption that I see showing up in the first quarter of the year with similar trends in Asia. So turning to the next slide. So let's just turn to what is happening with the fiscal support that was extraordinary during the pandemic. So fiscal support will be reduced across developed markets and emerging markets countries. We do see developed market central bank balance sheets shrinking by about $2 trillion, 1.2 trillion of that from the Fed by the end of next year. So that's about a fiscal drag of about 2 percentage points for the US this year. It still leaves us with a deficit estimate that's around 5.6% of GDP. But we are going to see some of this fiscal support and impulse reduced, and you can see this across the board, and that in the emerging markets countries, they had to start this much earlier last year. And so this is very different from the last cycle. In the last cycle, the balance sheet reduction started after the fourth rate hike, but the economic conditions were extremely different, and the budget, the balance sheet is much larger this time around. Just going through these aggregate numbers, looking at this chart, the governments in aggregate have spent $17 trillion on the pandemic, including loans and guarantees, 16% of total GDP. If you look at the public sector debt increase, it's 17 percentage points globally, while the central bank balance sheets increased by 21% of GDP in the developed economies. So turning to the next slide, what I mentioned is this is a very different expansion because of the strength of the private sector balance sheet. The aggregate balance sheet of the household is actually in great shape. It's supported by soaring asset prices, the $2.5 trillion of excess savings. And actually, as we take a look also at corporate profits, household wealth, and number of different metrics on the corporate balance sheet, we see also that interest expense is very manageable and cash holdings are at record levels. But let's turn to the inflation question. And I'm going to echo a lot of the themes that you heard from Matt. We do see the Fed starting to hike rates in March. We see a total of 5 Fed hikes projected this year, but we also have 2 in the first quarter of 2023. We do see US core PCE index declining to about 3% by the end of the year, Euro area core inflation to 2% by the end of the year. And we have the ECB beginning to hike rates in December, 75 basis points of rate hikes per year in 2023 and 2024. So just a very synchronized cycle there. And I think the high pressure means that when the facts change, that the central banks are acting. Turning to the next slide. We have seen 10-year Treasury yields, move, reprice very much more quickly going into the front end, and I think that the 10-year yield still looks expensive. We have 10-year Treasury yields at 2.35% by the end of this year, and we had created a negative yielding index monitor during the pandemic, and we have actually seen that negative yielding index just in the month of January was reduced by about $2.5 trillion, just as we've now seen that all 10-year yields have actually bounced back into positive territory just over this past month. Turning to the next slide, we do see emerging markets also hiking rates. Now, this started at the middle of last year, but we still have 14 out of 23 emerging market central banks hiking rates. The outlier is China. We still have China easing one more RRR cut and still really keeping most of the fiscal support in place, really only taking off by like 0.1% of GDP. And the EM central banks really did begin this much earlier. They just did not have the space, to keep the support in place that with the higher inflation, the buffer that developed markets had. I'm going to just delve a little bit more into inflation, but inflation is rising for both cyclical and structural factors. While we do see some signs of easing in the pandemic related supply chain issues, I would just point out that every supply chain was dislocated for a different reason. So this isn't going to be synchronized. But I want to talk about some of the structural forces that we see in place that are going to keep inflation higher. If you turn to the next slide. So, first it is, tight labor markets. We have unemployment going down to 3.3% by the end of this year. If you do a comparison after the global financial crisis at this stage, we were at 9.5% unemployment. We have, so we are seeing just, the increase in hourly wages, the labor force participation rate, also that has not returned to where it had been. It's over 55, but it's also women and the labor force participation rate. And all of this means that the Fed had to move faster, that these are not just transitory measures. These are measures that can continue to play out, 6 to 18 months, into it. But let's take a look at the next slide. And just really to illustrate that we have tight labor markets and a still incomplete recovery. And just taking a look at this chart, which we really tried to show is just where labor force participation is right. And you can see the US all on one side still below some of these other countries like Scandinavia that have recovered. But I would just stress that it is an uneven recovery. We've actually have emerging markets 4% below where it was pre-pandemic, and we have taken down emerging markets potential growth by 0.5 percentage point. Turning to the next slide, it's not just labor markets, it's also housing prices. Globally, housing prices are running at a 40-year high right now, and prices for rent, shelter, vehicles are going to continue to attract a lot of attention. Now, looking at shelter, it accounts for a very large share of the CPI basket, 33% of the total, 42% of core. And we do have a home price appreciation index is going up another 12.5% this year. And this is after rising 30% over the last 2 years. But again, we see this as a global phenomena, macroprudential measures already in place in much of Asia to address housing prices. So our forecast for core PCI to increase or about 3% anticipates a pickup in shelter inflation to an annual rate in the mid-5s. Looking at the next slide, we were getting a lot of questions about oil prices because of the geopolitical tensions in Russia and Ukraine. And I would say it doesn't take much to tip Brent to $120. I mean, if you were to see a military invasion, I do think that sanctions would be applied and the Russians could retaliate by cutting oil supply. That could take oil to $120. Now, it's not a base case. We don't think a major military invasion is in the base case at all. But we did take a look at the numbers and really look at what if you did have a negative oil supply shock with Brent at 120 or 150. Our forecast is 90. But if you look at the impact this would have on economic growth, it would dampen global GDP growth, and from a 4.1% first half performance to under 1%, it would push inflation up about more than 4 percentage points from 3 to 7.2% annualized. I can, I had a few more slides on the market. If I can just really stop there, because I think I've used my time, and very happy to take any questions during the Q&A.
Wonderful. Thank you so much, Joyce. That was great. That was a great kind of overarching perspective on, and was a nice addition to what Matt was talking about as well. So we have a bunch of questions. Unfortunately, I don't think we'll be able to get through all of them. So I'll try and pick out a couple of themes and throw it out there in front of the panelists. Let's go in the same order. I'll put forth a question, then Matt goes first, Joyce. And I apologize in advance to any participant if I don't do justice to your question or I'm not able to get to it. So the first question, and the three of you touched on it in some form or the other, are implications of your outlook for growth and, importantly, policy for asset markets more broadly. So all of you remarked about how part of the strength of the private sector comes from high home prices, high equity prices, and that's kind of buffered this growth picture quite a bit. So how do you see Fed policy kind of interact with that? Do you see a big risk of a sell-off in either equity markets or a sharp correction in home prices or in risk? Let me maybe frame that as a comment about risk premia and risky asset classes in general. So I take it, I'll let you guys pass the baton along. Go ahead, Matt.
I would start with that question by saying, what is the Fed's intent with what they're doing? And I think their intent is to tighten financial conditions in order to rein out some excesses that they're seeing in the market. But I think more importantly, to impact the demand side of the economy to hopefully bring supply demand back into better balance, and therefore to alleviate some of the price pressures that we're seeing. What does that mean? I guess that means to tighten financial conditions. They do want to see, I think, equity valuations lower. I think they want to see credit spreads wider. I think they want to see real long-term yields higher. And we've seen, certainly some repricing in that direction. But just to give you maybe a summary statistic for where we are relative to where we were before the pandemic, in late 2018, when the Fed was signaling in a quite hawkish direction, and markets were really falling off at that point, we were pricing a terminal Fed funds rate around 3% in nominal terms, and we were looking at a real 10-year yield at about plus 1% in real terms. Today, we're talking about a terminal Fed funds rate. Market pricing has moved a lot, but it's about 1.8% today in nominal terms. And real 10-year yields are still in significantly negative territory, about minus 45 basis points. So I think from this perspective, what we've seen in markets from the Fed's perspective is good. It's healthy. There's a question I think I saw about the Fed put. I would say that the Fed put is far away because they do want to see financial conditions tighten to rein in demand. And I think in thinking through asset classes, that's the important thing. I would maybe just add, if you look back at the past few Fed tightening cycles, mid-2000s, the last one, they were all met with significant curve flattening. And it was done in a way which was a twist flattening. So the long end of the curve was stable to down as the front end repriced significantly. And I think we had that dynamic because the Fed was removing volatility and was able to guide across the entire path in terms of what the terminal Fed funds rate was and what the pace was. This environment is very different. When the Fed raises rates in March, I don't think that they're going to provide significant forward guidance about where they're going to go because they don't know at this point. And we've seen how much their guidance has changed just over the past several months. That, in addition to the balance sheet, which is going to be drawn down much more quickly, presents a lot of uncertainty and a lot more volatility across the curve, which I think it impacts risk markets as well.
Joyce, the floor is yours.
And so I do think that, my presentation had been called the return of volatility. So I think the market volatility is here to stay. And I think what the Fed will look at is not so much the asset prices, but whether you really see credit conditions tighten that much. And here we're really not seeing that much of a move. We're seeing the move in asset prices. So we have an S&P 500 target at 50-50. But I would say that this is a year where I think that the emerging markets and international equities will outperform the US. And even in the sell-off in January, we had emerging markets down 2%, developed markets down 5%. But I would say that there are some aspects of the U.S. equity market sell-off that do seem like they're overdone. In particular, when we look at small cap stocks, I mean, these are actually trading now valuations at a 20-year low. And there are many market metrics, that we look at right now: high versus low beta stocks, valuations of small caps that are already fully pricing in a recession, which is something that we do not see materializing. But an important thing that I would say about market structure is that we are looking at both for the treasury market and for the equity market depth that is sort of at some of the lowest levels that we saw, right when the pandemic broke out, and that is, exaggerating some of these price moves, as well. So I think that the focus on asset prices is going to remain there as we see, this hiking cycle proceed. In the credit markets, we still see very strong demand in the U.S. corporate bond market. We're projecting 1.35 trillion of U.S. high grade corporate bond issuance. Very low default rates. We've also seen that corporations have been able to extend maturity. Interest rates, you've been able to refinance. Interest payments are very low. So I don't see this yet really hitting the credit conditions that much. I do think that the volatility, though, is here to stay in asset prices. And part of that is just due to the market depth. And by market depth, I mean the amount that actually trades, is really quite low compared to some of the market moves we see.
What do you see as the risks to the outlook that you painted? I mean, Matt, and all of you talked about it a little bit in your presentation, but maybe we can say, which side do you think the risks are tilted towards? And in that discussion, maybe we can comment on this, somewhat sanguine picture that bond markets, especially long-term bond yields, are telling us. Is that, and what your kind of take on that is? So again, let's go in the same order. Matt, Joyce.
From a risk perspective, I think the key concern on my end is that we don't have this dissipation of price pressures over the course of this year to the extent that we anticipate. And that forces the Fed to move more aggressively than we have as a baseline. And so we have certainly suggested that the Fed could raise rates every meeting this year, 6-7 times. If that is in fact the case, could have to do more next year. And while I completely agree with all the comments about the aggregate consumer picture looking very strong from a balance sheet perspective, the consumer is facing a lot of headwinds today. And I think you see that reflected in consumer sentiment in indicators, which are actually quite negative at the moment. And those headwinds are, one, price pressures and the significant that you're seeing increases in prices, particularly for energy now, which is a big drag on income that they have to spend on other items. Typically about a cent in gas is about $1 billion, a little bit more reduction in income that you can spend on other items. So that's a really important drag. Two, we've seen sources of income like the child tax credit go away. That was 150 to 200 billion for households. Three, real wages, although we're seeing nominal wages increase, we're seeing real wages declining, and consumers expect that to be a dynamic that goes forward. And then fourth is, yes, we have $2.5 trillion of excess savings, but that is significantly skewed towards the upper end of the income distribution and older households. And so I am concerned in this environment that if the Fed is forced to move much more aggressively, that we could see a downturn and perhaps recession risks. We haven't seen the Fed have to fight inflation historically in an environment and then land that in a soft landing to the extent that we are anticipating at this point, given how high inflation is. And so just as a data point that I would throw out there as a risk, our favorite cyclical indicator for consumers is taking the gap in present conditions between the University of Michigan and Conference Board. And this metric is shockingly cyclical to the extent where it is 80-85% correlated with the 2's10 slope. And it's currently telling you that consumer sentiment is at the lowest level in more than 50 years. The curve should be inverted. Recession risks are about 50% over the next year. I think there's probably some reasons for that, but given the robustness of that indicator historically, I do take that as an important signal. And I would be concerned about the consumer outlook in an environment where the Fed has to move much more aggressively than what we have penciled in.
Joyce?
Yeah, so let me talk about the risk, and then I'll talk about the Treasury yield curve. So I do think that the risk is higher inflation because of higher oil prices, and that that the geopolitics are something to watch. That's one risk to monitor. And I am not so worried about a housing bubble. I think the next crisis really is a housing affordability crisis. Now, that's because inventories are still about lower than they were a year ago, but it's also because of the demographics. Just when we look at the demand growth from millennials and some of the demographic shifts. But just turning to talk about the Treasury market. So we're getting a lot of questions. Why is the curve flattening so much? And isn't it telling us that an inflation is here? So first, I'd put it into context. During the pandemic era, if you look at the era, the 5s, 30s curves reached its steepest levels in the middle of 2021. So it's been ratcheting lower since then, and it's now about 44 basis points. It's about 22 basis points below its average in January of 2020. That's like their pre-pandemic baseline. So some people are beginning to question whether that means that we're getting to some signal about recession. But I think that one thing I would say is that this kind of flattening has had precedence. During an aggressive flattening in 2018, we did a deep dive on the causes, and the fundamentals really point towards a structurally flatter curve than experienced in prior expansions, is what we have seen. And that's because of slower potential growth, which naturally lowers the neutral Fed funds rate, the equilibrium rate at which the economic growth is neither stimulated or restrained. So there's lower, neutral policy rate that limits the extent that long-term yields can rise in the current environment. Then there's the weak labor supply, the productivity growth, the trend growth in the U.S., which has been on a declining trend. So that's just some considerations to take a look at. With the expected neutral rate declining and maybe bias lower, this is likely to put a cap on the longer-term yields. So we do think though, that Treasury yields, 10-year yields should go to 2.35%, but just wanted to throw out some reasons why, they do seem like they have just, remained, they have not risen as much as one might have thought they would.
Great. Thank you so much. And that kind of takes me to the next part of this discussion, which has to do, all of you touched on this theme throughout your remarks, that has to do with supply chains, right? So obviously one thing the pandemic of the last 2 years has done is increase the salience of supply chains for everybody. I know more about how ports work than I ever thought I would know. And what I wanted to ask you as a kind of to frame this debate is in both a near-term perspective and perhaps a longer-term answer, right? So one question is about the near term. Do you see policy either through the infrastructure law that was passed last year or through some of the new initiatives that administration is talking about having a meaningful role to play in in the supply on the supply side or in relaxing some of these supply chain issues? And that's kind of maybe the more immediate term question, or the more short to medium term question. And then the longer term question of how do you see this kind of renewed attention to supply resiliency affecting growth and perhaps even government policy going forward? So I wanted to kind of leave that second part open-ended. So answer, if you could take whatever perspective on that as you deem fit. Matt, take it away.
Sure. I think on the first one, I would go back to kind of the complexity of the supply chain issues that were brought up earlier. And yes, we can do things like try to run the ports 24 hours as we have. But I think that basically clears one part of the chain that's an issue and just pushes the issue downstream. And essentially I think that's what we found. And so on other items like releasing some of the oil reserves, we've seen, crude go to $95, $90 a barrel here for Brent. And so obviously there's been not as impactful of a policy response as we would have anticipated. So I don't see, a policy response being able to meaningfully improve the supply chain issues that we see over the next several months. I think the bigger help to that will likely come on the demand side, as I mentioned kind of earlier, which is we've already seen ongoing this reduction in real goods demand, particularly for durable goods that has happened. And I think if that can continue to happen over the next several months, that is probably the most important driver in the near term for helping ease some of these supply demand imbalances. From a longer term perspective, I think Nathan alluded to it, but it's clear that the resiliency or lack of resiliency of the supply chains was an important takeaway for many firms. And so there's been, moving from just in time to just in case, and do we have bigger inventory builds that take place? I think that will certainly be true for a period of time. But I think also what we learn is as we move away from massive shocks, and this was mostly a once in a lifetime shutdown of the global economy and shock to global supply chains, that will likely prove to be a transitory thing over time, in the sense that, yes, we can build up inventories for a while, but at some point investors will come to those businesses and say, why are we holding this excess buffer to build up against a once in a lifetime shock? I think the more structural thing that we may see, and again, this was happening before the pandemic, is just focus on a bit like deglobalization, but reshoring some activity, moving it away from certain geographies that are believed to be more vulnerable. That I think is probably a more persistent thing that we will see, and that'll be on net additive to inflation. We've tried to look at some of the structural issues and what it'll mean from a deglobalization perspective. We think that could add 20 to 30 basis points to core inflation going forward. And so I do think that is a longer term structural issue that may be more persistent.
Joyce?
Yeah, so I would just say that on the supply chain that, every supply chain was disrupted for a different reason. So you had the starting with the ports, but it was air freight. Then it went to the truck drivers and the shortage of truck drivers. So it's not going to be synchronized coming out of this, but we do see a buildup of inventories. Like we have buildup of inventories adding about 0.5 percentage point to U.S. growth. So some of those supply chain issues will, be addressed. But as I mentioned, there are the structural issues, and I thought I would just maybe walk through more of why we are concerned about the energy market. So we do see structural issues on energy prices as well. But one one thing that we have looked at is that we think for the large oil companies that between now and 2030, there's probably about a 650 billion global capex shortfall that you've had for large oil companies. And that's one thing that also does contribute more to just the upward pressure on oil prices. I also think that Russia is keen not to jeopardize its relationship with the core natural gas consumers in Europe. So it could instead aim to constrain oil supplies in the global market, which would actually cause more harm to the U.S. And that disruption could be more harmful. So I do think there's some structural elements that are in place, and that some of these things like how they deal with Iran are hard to just predict whether they will actually have a breakthrough on that front. But so I think that we are in a period where the inflation is going to be could be 100 basis points above where we were pre-pandemic, and central banks will need to be very mindful of how they're looking at this mix of quantitative tightening and as well. And so we do also back of the envelope look at the quantitative tightening as maybe another 1.2 trillion, another equivalent to another 25 to 50 basis points of tightening.
Great. And so that takes me to the next question, which I think is related to a number of questions in the Q&A. It has to do with the somewhat divergence between China and perhaps a lot of the economies in the West. A lot of this, especially some of these structural trends, perhaps towards reshoring and or other stuff, seems to have different implications for China and for the US or for Europe. So what I thought, maybe I could give you guys a couple of minutes to just lay out your China kind of outlook. I know you talked about it briefly in the course of your opening remarks. So I'm going to, Matt, I don't want to put you in the spot here. So if you want to say pass, you are perfectly welcome to do that. But if you'd like to weigh in, that would be great too. And just a couple of minutes on what you think is the outlook for the Chinese economy. China has its own set of pressures from its real estate sector. There's a whole bunch of uniquely Chinese kind of forces in play. So maybe a couple of minutes on that would be great. Matt?
If okay, Venky, I think the audience would get a lot more value from Joyce's insights on this one. So maybe I'll pass it over to them first.
Great.
I do think, as you mentioned, China was first in, first out of the pandemic, but we do think that the pandemic in many ways did reprice China. We see the Chinese economy reaching the size of the US economy before the end of the decade. And so that's probably accelerated what our previous forecast has been by 3 to 4 years. Now, I do see China's growth slowing down. As I mentioned, we have China's growth at 4.9%. But I would also say that you do have major demographic shifts that are going on in China. And if you actually just look at the birth rate numbers that came out, it was sort of one of the lowest that they've ever had on record, even within the margin of statistical error. It could even have been negative this year. And so they don't need the type of double-digit growth that they had before. I think the Common Prosperity is very much focused on trying to balance growth towards their longer-term objectives, to raise the standard of living, to develop country standards, in income and in just well-being by 2035, 2049. And so I think some of the regulatory tightening that you're seeing is going to continue. I mean, on some of these large internet platforms, community plays, I think they, will continue to be concerned. Just housing in China is, 60% of household wealth. That's like double what it is in the US on managing, the real estate sector as well. I think this is a long-term agenda on China's part. The other thing I would just say is that, we are seeing, though, even with U.S.-China tensions, with the volatility we had in the market, we are seeing that China is going into the mainstream indexes for investors. And so I think very few people would have thought that in 2020, the year of the pandemic, originating in China, that you would have ended 2020 with 476 billion of foreign portfolio capital flows, an all-time record bar none, into China. So we do see China's growth slowing down. The key buzzword this year that China has been using is stability. but they also are sort of, desynchronized from the rest of the global economy. It's one of the few places where they are putting easing measures into place as well. And just as they were first in, first out, they've been able to sort of run against what some of the developed market central banks are doing as well. So, so I see, every reason why just on, the China scenario, we're going to continue to see it between the U.S. and China, a real strategic competition, very much as Nathan said, a focus on for the U.S. side on securing the supply chain and area that are deemed as critical infrastructure, national security issues, a greater focus on cyber attacks, as well.
Wonderful. So I want to kind of end this with one question. And unfortunately, it's going to be a question on which we could have an entire session. So I apologize in advance to the panelists for that. But a lot of the questions, both in the Q&A and in the earlier questions we received, have to do with, this kind of renewed focus on, and perhaps a long overdue focus on ESG and climate change in the corporate sector more broadly, but also very much in the eyes of policymakers. So, there's perhaps this, if he had more time, I would have framed this as a two-part question saying, should, policy and especially monetary policy get weighed into this? But maybe in the interest of time, you can kind of mesh that into how you think those considerations are going to shape policy over the medium term, and your thoughts on that. Again, we'll start with Matt.
So from a U.S. outlook perspective, I thought there was a really nice piece done by the Peterson Institute that was looking to try to quantify the size of the shock moving to a much lower carbon concentrated economy, and was equating it or making parallels to the 1970s oil price shock in terms of the size of the shock. I think that is probably an apt one, but what really matters for the U.S. economy, the global economy, is the transition path and how abrupt do we go from here to there. I think what we've learned from a policy perspective in the US with the Build Back Better plan, now at this point looking like it's not really going anywhere in its current form, is that process for the US, if it begins, is a slow one. It's not an abrupt one that helps along the transition path to make sure that the price shocks are not as extreme, the growth shocks are not as extreme. I think we see some of the impacts through energy price pressures already with some of the reduction in supply today. But I think the key from my perspective is it is one that we will have to factor it into a greater extent in our forecast going forward. I think it is one that will be additive to inflation along that transition path. It is one that will be positive from an investment perspective along that transition path. But we haven't begun to really factor that in until we get greater clarity on where policy will be driving things over the next several years.
Joyce.
Yeah, so I would just call the ESG the good, the bad, and the uncertain. So what's the good? 140 countries that are responsible for 90% of emissions now have net zero goals or targets, and that's a big change. The U.S. joining the Paris Agreement, the Biden Earth Day summit that he had, COP26. If you take a look at corporations, you now have about 40% of Forbes 2000 companies that also have put in net zero targets. So that's the good. The targets are there. Even China, India, Russia are talking about net zero targets, but the bad is they're decades away, and we are in the first energy crisis of the decarbonization era. And that is bringing home that, we still have not peaked for the use of fossil fuels in China, and that it's going to take decades to meet some of these targets. And even if one sees green investment as the opportunity for the century, we estimate a financing gap annually that's about $2.9 trillion. And so when you look at investment into clean tech and clean energy, yes, it did hit record levels last year, but that was $60 billion only. And what you do have is that many of these technologies, are really quite expensive. They need policy incentives to undertake them so that the government takes the first loss. And so a lot of this venture capital, still pretty small in sums, but still, sort of very much an experimentation. So there's sort of the bad. And then there's the uncertain, and the uncertain is the greenwashing, the need for data and standardizations. Also that, there's going to be a closer look at performance of ESG funds. And last year was an underperforming year. The ESG funds underperformed as traditional energy came back by about 33 basis points after outperforming in 2020 when oil prices had gone down. So there's still a lot to sort of figure out in the right way to sort of implement and standardize. There's still a big implementation gap despite all of the common goals now on ESG.
Wonderful. Thank you so much. Unfortunately, we are out of time. I would love to keep talking to you, but I'm very extremely respectful of your time. And on behalf of everybody, the NYU community more broadly, the students, the alumni, and everybody on this call, I'd like to extend our gratitude to all three panelists for joining us and sharing your wisdom on a range of topics. I think all of us benefited immensely from this, and I really want to express our gratitude, our thanks to you again. I look forward to welcoming you in person to NYU down the road. But again, thank you so much for making the effort to attend this. Just a quick comment. Next week, we are going to have President of the Cleveland Fed, Loretta Master, join us, so I can grill her on climate change as well. So thank you so much again. I'm going to end the seminar here, and I want to end again by thanking all of you for attending and the panelists for their participation.